Good morning, everyone, and welcome to today's webinar covering certain sections of the Consolidated Appropriations Act. I'm Kyle Neild, a partner with Mercadien and co-leader of the firm's nonprofit and human services group. Joining me today are Sherry Ritter, Matt Smirsiak, Elizabeth LaCourte, and Caitlin Kolczynski. Before we begin, I want to cover a few housekeeping items. All participants are muted, so please use the chat feature to submit any questions you may have. We will address questions at the end of today's presentation. Today's seminar qualifies for continuing professional education credits. In order to qualify, you must be logged in using the link provided to you via email. You must respond to 3 of the 5 polling questions during the webinar. You will have approximately 60 to 90 seconds to respond to each of the polling questions. You will not earn CPE credit if you log in using someone else's link to the webinar, if you are joined today by telephone call only, if you fail to successfully complete 3 of the 5 polling questions, if you fail to remain logged in for a minimum of 50 minutes, or if you only view this recording of the webinar. After the webinar, an evaluation will be sent out to all participants. You must complete it and return it to us in order to earn CPE credit. CPE certificates will be emailed within 2 weeks after today's webinar. Next slide. During today's webinar, our thought leaders will walk you through certain portions of the recent COVID-19 relief bill known as the Consolidated Appropriations Act, which provides additional relief funding for businesses, healthcare and educational institutions, as well as a second round of funding under the Paycheck Protection Program. This webinar will highlight key elements to optimize your benefits and help you continue to navigate the economic uncertainty that continues into 2021. We will also provide information on how Mercadien can help you and your business and answer any questions that you may have. The Consolidated Appropriations Act is a $2.3 trillion spending bill that consists of $1.4 trillion for omnibus spending and $900 billion in stimulus relief. This 5,600-page bill was signed into law on December 27th, 2020, and it consolidates the COVID-related Tax Relief Act of 2020 and the Taxpayer Certainty and Disaster Relief Act of 2020. The bill funds the federal government through September 30th, 2021, and key provisions of the bill benefit individuals and businesses, including $284 billion specifically set aside for the Paycheck Protection Program, and changes and expansion of the Employee Retention Tax Credit. Now I'm going to turn it over to Sherry.
Thank you, Kyle. So I'm going to talk a little bit about an overview of the individual, let's see if I can get this advanced, guys. The individual provisions and the business provisions. As soon as I can get my slide.
You might just have to click back on the slide there and then try to advance.
Thank you. So some of the biggest individual initiatives and relief provisions are the extension of the unemployment insurance. So as I think many of us know and recall, there was a lot of talk about the additional $300 per week that anyone that was claiming unemployment during past the CARES Act was getting an additional $300 a week. And the pandemic unemployment assistance has been extended now based from the CAA through March 14th. So it also allows individuals who are receiving benefits as of March 14th, 2021 this year to continue receiving their benefits through April 5th, as long as they haven't reached their maximum weeks. And as you can see here, it increases, the CAA increases the number of weeks that you can collect from 39 weeks to 50 weeks. It also allows for support to the state by the federal government of up to 50% of the benefits, the cost of the benefits that are provided to nonprofit organizations and employees of the government. I think, as we've all heard through the media, that it provides for recovery rebates for individuals, and that is a $600 per eligible family member rebate. So if you're a married couple and you have a qualifying child, you would get $1,800. And currently, the rebates are based on the income level on your 2019 income tax return that you filed. So the credit will be phased out starting at $75,000 if you're a single person. And if you're a head of household, that credit gets phased out starting at $112,500. And if you're married filing jointly, it's $150,000 where the phase out begins. So this is, the advance payments are based on the 2019 income tax returns. I think it's important to note that you're going to reconcile the amount of the credit that you're entitled to on your 2020 income tax return. So those credit phase outs are for your, technically for your 2020 income tax return. Why I said 2019 is because that if you had over $75,000 and you were a single filer on your 2019 return, even though you filed, you would likely not get the $600 rebate. So if your income went down in 2020, let's say you had over $75,000 in 2019, you filed your return, you didn't get the rebate. On your 2020 return, and you earn less than $75,000, you will, through the filing of your return, get your rebate. And I think another item of note is this is the new president is talking about increasing these rebates from $600 per person to $2,000 per person. Of course, this is just what's in his plan. It hasn't passed. And to my knowledge, it's regardless of income level. So these caps, if his plan goes through the way that he is suggested, it will be to every taxpayer, regardless of income. So let's talk a little bit about the individual provisions. The CAA permanently increased the deduction, for medical expenses. So if you itemize your deductions and your total medical expenses exceed 7.5% of your adjusted gross income, you can deduct, as part of your itemized deductions, the balance of those accumulated medical expenses. Previously, the law allowed you a deduction if your medical expenses exceeded 10% of your adjusted gross income. The child tax credit and the earned income credit. So these are based on the amount of earned income that you report on your tax returns. And the CAA allows temporarily individuals to use their income from 2019 if it's higher than 2020. So that's a temporary provision for the 2020 tax returns. charitable contributions. So in the past, excuse me, the only way that you could take a charitable contribution deduction was if you itemized your deductions. And the CARES Act, which was passed earlier in 2020, created a new above the line deduction for charitable contributions that were made in 2020 for taxpayers who do not itemize their deductions. And the maximum allowable deduction is $300 for a single person and $600 for a married couple. And the CAA extends this rule through 2021. The income limitations for charitable contributions. So under previous law, you could only take a charitable contribution to the extent that it didn't exceed a certain amount of your adjusted gross income. So previously, charitable contributions were limited to 60% of your adjusted gross income. A couple years back, it was 50%, then it was increased to 60%. And the CARES Act removed that limitation for 2020. So in essence, you were allowed to deduct up to 100% of your adjusted gross income. And this CAA also removes the limitation for 2021. So it's an extension of the CARES Act 100% provision. With regard to education credits, the CAA removes the above the line deduction for tuition and fees in exchange for an expanded application of the lifetime learning credit. So this applies to tax years 2021 and beyond. So if you think about it, a tax credit is usually much more beneficial than a deduction because it's a dollar for dollar credit against your income tax liability. Exclusion from income for forgiveness of qualified personal residence, indebtedness, forgiveness of income, or what we call cancellation of debt income, is generally included as taxable income on your personal tax return or your business tax return for that matter. An exception applied for forgiveness of debt that was used to acquire your personal residence. The maximum that you were allowed to exclude was $2 million for a married couple. And this provision was supposed to expire in 2020, but the CAA extends this exclusion through 2025, but at a reduced amount of $750,000. So I'm sure there's a number of people out there that have not been able to pay their mortgages, and so this provides some relief for them to the extent that they've gone into foreclosure. Mortgage insurance premiums. So the CAA extends the deduction for qualified mortgage insurance premiums through 2021. If depending on your income level, you may have to pay mortgage insurance, and it's like it's an additional amount over and above the interest that you pay on your mortgage. And then finally, retirement plan distributions. So the CAA allows for distributions from retirement plans of up to $100,000 per person in 2020 without being subject to the 10% early distribution penalty. The distribution will be subject to income tax over a 3-year period unless you elect out. So you can take, people were, suffering during the pandemic, and the CARES Act allows you to take a $100,000 distribution from your retirement plan without paying the 10% penalty. But remember, your distributions from retirement plans are subject to income tax. The way the rule works for this provision is that you pay tax on that $100,000 if you took the whole $100,000 over a 3-year period unless you elect out. So the other piece of it is if you choose to, you can pay that back, i.e. recontribute some or all of the funds that you withdrew by the 3rd year. And if you do that, then of course you're going to have to amend your return because you don't have to record all of that income. It's a lesser amount, or maybe zero. The CAA extended this relief provision and allows all taxpayers, regardless of income level and regardless of those that were directly affected by COVID, to be able to take this $100,000 without the 10% penalty. A lot of information on the individual provisions. Business, really three key items that I want to talk about. The biggest one I think everybody's heard about is those PPP loan proceeds that you received from your PPP loan. It's always been the fact that the proceeds are not reportable as income on your personal or business income tax return. The challenge was there was a lot of discussion about should the deductions be disallowed because you didn't report the income. And clearly the CAA has made it permanent that the expenses that you paid with the PPP loan proceeds are tax deductible. There's a little perk here about business lunches. We call it bringing back the business lunch, and the CAA temporarily allows you a full 100% deduction for meals provided by restaurants that are paid or incurred in 2021 and 2022. And we can all imagine that's to help out the restaurant industry. And then finally, qualified disaster relief contributions. The CAA creates a new category of qualified disaster relief charitable contributions for qualifying contributions made to organizations for disaster relief or efforts. Contributions have to be made between January 1st, 2020 and 60 days after the passage of the CAA. So in a roundabout calculation, by February 24th of 2021. And corporations can receive a deduction of up to 100% of their taxable income. So previously, and Elizabeth, you can correct me if I'm wrong, corporations could only deduct charitable contributions if they exceeded 10% of their taxable income. So it's a little perk designed to encourage philanthropic efforts on both the individual side and on the business side. So now I'm going to turn it over to Caitlin to talk about the payroll provisions. There are many, and she's going to actually go through quite a few here and then talk further about the expansion of the employee retention credit in more detail. Caitlin?
Thanks, Sherry. As Sherry stated, that there were many payroll provisions that were affected through the legislation that was just passed, and they were either expanded or extended. So starting with the FSA plans, employers can now choose to carry over unused funds from 2020 to 2021 and from 2021 to 2022, or extend the grace period for spending unused FSA funds to 12 months after the plan year. With the emergency paid sick leave due to COVID-19, which was first required under the Family First Coronavirus Response Act, which provides employers a payroll tax credit for this leave time, the CAA extends this credit through March 31st of 2021. Additionally, this is now a voluntary program, is no longer mandated as it previously was under the FFCRA. Earlier tax law allowed businesses to claim a general business credit for paid family and medical leave up to 12 weeks per year. This provision was set to expire at the end of 2020, and the legislation now extends this credit through 2025. The Work Opportunity Credit is available to employers who hire individuals from certain targeted groups. This credit was also set to expire at the end of 2020 and has additionally been extended through 2025. The Employee Retention Tax Credit, I'm going to speak more on in a few moments, but generally this credit was expanded eligibility through the CAA, the credit was increased to 70%, and the credit itself, the time period for it was extended through June 30th of 2021. In August of 2020, there was an executive order that allowed employers to defer the employees' share of Social Security taxes between September 1st and December 31st of 2020. These taxes were then required to be repaid through a reduction of the employees' pay between January 1st and April 30th of 2021. The CAA has extended this repayment period through December 31st of 2021. And generally, this wouldn't necessarily be advisable because this credit in general, because if the employee leaves during this time, the employer is then on the hook to repay this balance. So it's just something to keep in mind if your company is involved in this. And finally, with the employer payment of student loans, the CAA extends the current CARES Act provision, which allows employers to repay education loans incurred by their employees. This was also set to expire in 2020 and has been extended through 2025 with the maximum amount paid to each employee of $5,250. There's a lot of things to consider there. Sherry, you can go back for a second. With the changes to the employee retention tax credit, under the CARES Act, the CARES Act provided an eligible employer with a refundable payroll tax credit equal to 50% of certain qualified wages paid to employees beginning March 13th of 2020 through December 31st, 2020, if the employer engaged in a trade or business and wages were paid while the operation was either fully or partially suspended due to government orders related to COVID, or during the period beginning in the first quarter in which gross receipts for that business were less than 50% of gross receipts compared with the same quarter in 2019, and ending in the first subsequent quarter in which the gross receipts were more than 80% for the same quarter in 2019. So there's a lot there, and so we're going to unpack that a little bit in these next coming slides, and just break that down to see how that was affected with the CARES Act and what is now retroactive or expanded through the CAA. So the first thing with the qualification, as I said, eligible employers were businesses that were suspended through government order or had gross receipts that had declined more than 50% over in the same quarter of 2019. And effective for 2021, the suspension is still in effect if that happens, but now the gross receipts test is now if the gross receipts have declined more than 20% for the same quarter in 2019. So there's now a lower threshold for the gross receipts test. Additionally, companies can choose to elect to compare the preceding gross receipts to the same quarter of 2019. So for example, we're in Q1 of 2021, you could choose to compare Q4 2020 to Q4 2019. And for businesses that did not exist in 2019, you can use the corresponding quarter in 2020 for the gross receipts test. One of the major differences were the PPP borrowers and what changed under the CAA. Originally under the CARES Act, the employers that received a PPP loan were not eligible for this credit at all. And effective under the CAA, and this is retroactive looking back to 2020, if you received a PPP loan, you can now be eligible for that credit, and you can amend your Form 941s to claim those credits for 2020, and as well as any eligible credits going forward into 2021. However, the credit cannot be claimed for wages that were paid using proceeds of a PPP loan that have already been forgiven. So we're still waiting on some guidance from the IRS and how that all interplays, but that's one of the major factors that PPP loans borrowers are now included in this. Employer size also plays a factor into how the credit is calculated. Originally under the CARES Act, employers with more than 100 employees could only take the credit for wages paid to employees who were not working during the eligible quarter. And with employers with less than 100 employees, all of the qualified wages were eligible, even if the employee was still working. Under the CAA, this limit has been increased to 500 employees. So that is making this credit more accessible to different employers. And it actually simplifies the process as well, with employers not having to segregate out the wages between working employees and non-working employees. You can go next slide. The amount of and limitations of the credit, you can, under the CARES Act, you could claim a credit against 50% of the qualified wages, up to $10,000 per employee per year between March 13th and 12/31, which resulted in a credit per employee total for 2020 of $5,000. Under the CAA, this has been expanded, and it's in effect for 2021, so not 2020. But now this credit can now be claimed against 70% of qualified wages per employee for up to $10,000 of qualified wages per employee per quarter. So now the max credit is now $7,000 per employee through the beginning of the first half of 2021, or $14,000 through June 30th per employee. Calculating gross receipts. Pre-tax health benefits are included in these qualified wages. I also mentioned that if you had more than 100 or 500 employees, depending on which time period you were looking at, you can only use the wages for those who are not working. And you cannot use qualified wages for paid family leave or wages that were paid with PPP proceeds, as I had previously mentioned. The CAA has also clarified the definition of what gross receipts are, and they are using the definition that they use for tax exempt organizations, which includes total sales, amounts received for services, business income for business activities, sale of assets, and investment income, etc. So you can keep going. How to claim the credit? You're going to claim this credit through your 941. If you're looking back to 2020, you're going to have to amend the 941s and just reduce the amount that you would need to typically pay on those forms. And you can also, going forward, you can request in advance using form 7200. I think we're still waiting on an update to that form, because as of last look at it, it was only updated as of March 2020. So it's still missing the first quarter if you were to use it for this quarter. So I think that is still needing an update. So it's important to note that we're still waiting on guidance from the IRS on these forms. So if you were to go to look at the IRS website, it's the facts are still only updated through the CARES Act, not under the CAA. So we're still waiting for details. Go one more. So generally right now, if you think that you're eligible, we can review your gross receipts from the time periods that you think that you would now be eligible, especially if you receive the PPP loans, and how that interacts with the qualified wages. So, and just understanding your eligibility and helping you claim that credit. So now I will toss it over to Elizabeth.
Okay, thank you. I'm going to go through some of the changes to the Paycheck Protection Program and what has occurred between the first round and the second round, and some of the changes to certain definitions for certain costs. Next, please. Okay, so the qualifications under the CARES Act just had US businesses, 501c3, certain veterans organizations, and you had to have less than 500 employees. So now the CAA has added 501c6 organizations, 501c19 in certain housing co-ops, and now it's no more than 300 employees for the second draw. The maximum amount has been reduced on the second draws from 10 million to 2 million. The loan calculation is basically the same. Under the CARES Act, it was 2.5 times average monthly payroll. That's the same for businesses other than those that are in the food service accommodation businesses. They will have a 3.5 times their average payroll. Next, please. Okay, payroll costs. So the definitions for payroll costs changed slightly in that the Act clarified that healthcare includes not just the life, not just medical insurance, dental insurance, and vision, but that group life and disability are included in the payroll costs, which is your basis for determining how much your loan is going to be. So you have, again, the salaries, the wages, commissions that a person would earn, the group health insurance, the employer portion of employer retirement plans. So it's not the employee amount that's withheld, but the amount that the employer pays in, and the amount that the employer pays in for state or local payroll taxes. Again, not what has been withheld from an employee's paycheck. The Act did not change any of the caps. So the employees who earn more than 100,000, you have to reduce that down to 100,000 for your calculations. Owners are still capped at 2.5 months based on their 2019 either W-2 for a partnership, for a partner in a partnership, self-employment, for a Schedule C, a certain line that's on their Schedule C. So that is still in place for owners. That has not been expanded. Eligibility criteria in the CARES, you had to have economic uncertainty certification. There is still a question regarding that when you apply, that you do certify that there is a need to have this PPP loan. And one of the biggest changes under the Act, the CAA Act, is a criteria that you have to have a more than 25% drop in your gross receipts as compared to 2019. So you can look at 2020 and did you drop below more than 25% below your 2019? It can be any quarter. So if for most people, the second quarter was when the big drop occurred with all the shutdowns, et cetera. You just need to provide information for one quarter, or you can have an annual comparison of your gross receipts dropping by more than 25%, 2020 compared to 2019. And the CAA also clarifies, states that the PPP proceeds are not included in gross receipts. They do clarify that gross receipts are going to be from sales of products, services that are provided, interest income, dividend income, and there's guidance that shows for each particular tax type, a C corporation, sub S, Schedule C, what lines you need to look at, what sections of your returns you need to look at to calculate your gross receipts. If your loan is for less than 150,000 on the second draw, you do not need to provide this information about your drop in 25%. If it's more than 150,000, you need to provide some sort of support. Now, I've worked on a couple of these, and I did have a bank where a client was less than 150,000, and the bank did request proof up front, because for under 150, you provide that support when you go to ask forgiveness on the second round. But they had their own internal criteria that they needed for due diligence, and they requested that information up front. So we advise that you make sure you have your numbers of comparisons of the drop in gross receipts ready in case the bank asks for it. Next, please.
Can I just ask a quick question here, Elizabeth?
Sure.
I think a lot of the nonprofits that I work with and Kyle work with, they've been getting other funding, other relief program funding. So, you know, it could be grants, it could be a FEMA grant, it could be a state grant, money direct through DDD, could be HRSA, which is the Provider Relief Funds. That is included in your revenue, correct?
Yeah, there are certain, yes, funding that's included. One of the good things about some guidance that came out is the specific lines from the 990 and the specific schedules you need to look at to pick up gross receipts. So that's been very helpful. So you need to, for any of the returns, make sure that you're categorizing your gross receipts properly so that you have everything in the correct category that will be included or excluded for the gross receipts test.
And I think it would be fair to say that this has been pretty much our experiences. The attributes within this program are pretty much defined by tax law.
Yes.
Is that a fair statement? Okay.
Yes, the nonprofits, the tax exempt organizations, the IRS refer to the CAA actually refers to an Internal Revenue Code to look at. And the guidance that's come out from the SBA, again, references certain areas of the tax code and says as defined within the particular tax form or tax return. So there is a lot of going back to a tax return. And so that is really important to make sure you've got that, again, it's properly classified and done quickly, because my understanding from some bankers is that they want to have a copy of the 2019 return. And even if 2020 isn't done yet, at least a draft, so that they can take a look at the lines on the return that you put together to calculate the gross receipts. Make sure that did occur.
Okay, thank you. I think that we have a lot of questions about that, so I wanted to make sure we went over that. So thank you.
Yep, no problem. Okay, next, please. So the eligible expenses for forgiveness. So this is a payroll intensive. The whole point of the CARES Act and the CAA is to keep people employed and keep providing them their wages. So payroll costs, you must use your loan for at least 60% in payroll costs. Then the other 40% is the mortgage interest, rent, and utilities, as defined within all of the guidance. The CAA still has that 60%. So once again, in this draw two, you must have at least 60% in payroll costs. Now the other 40% for forgiveness, this is for forgiveness, not the calculation of how much your loan is going to be, this is for forgiveness. You can have covered operations expenses. You can have property damage that is not covered by insurance, supplier costs. So your everyday vendor, you must get supplies from, etc. And then PPE or work protection expense. You have for masks, sanitizers, glass partitions, changes to the building for air circulation and such. There's a very defined guidance as to HVAC changes that would be eligible for the proceeds being used towards. So that's expanded greatly. Again, for the 40%, everyone still has to keep in mind 60% must be the payroll costs. And now for the covered period, in the CARES Act, it was either 8 weeks or 24 weeks, depending on when you had your loan. If you received your loan, you had an option to take the 8-week or the 24-week. If you received your first round loan after June, then it had to be 24 weeks. Now the CAA states that you can choose your covered period. And there is no alternative. There was an alternative payroll covered period in the CARES Act. Now your period starts when the money hits the bank. So when you get the round 2 proceeds, that's your start time. It must be a minimum of 8 weeks that you use your proceeds for, the maximum of 24 weeks. But you can, if you have, let's say 12 weeks, 14 weeks, 16, that will be the borrower's choice. And this is just for the second round PPPs. The other eligibility for the PPP round 2 is that you had to have a round 1. And so these new organizations that I mentioned before, the C6s and such, they've now been applying, and your application date is until March 31st of this year. Your PPP round 1 application is under the CARES Act criteria, except for certain provisions that went backwards, such as the expanded payroll costs of life insurance, et cetera. So you have the 500 employee criteria versus 300. So you have to get your first one, and you have to use it by, or will be able to use it by the time you get your second PPP. So you see, there's a very short time frame for these new organizations that can now apply. They're applying now. They need to use and then apply for their second loan. So next, please. Okay. So the forgiveness application itself, under the CARES Act, they previously had 3 different kinds of forms. The ones for under 50,000, an easy, and your larger loans above 50,000 had a particular form. And we had all been waiting for the rumors that said if you had less than 150,000, it's going to be an automatic forgiveness. That didn't come out until the CAA. It's not really automatic. There's mostly certifications, and you don't have to give the lender all of the support and documentation. Though I did have a banker did ask for information, even though the loan was under 150,000. So again, borrowers are going to be subject to whatever their bank has as due diligence. The CAA also clarified that your EIDL advance under the CARES Act, that advance that you received was going to be deducted from your forgiveness amount. So if your forgiveness, for example, was 150,000 and you had received a $10,000 advance, then your forgiveness was going to be 140 and the 10,000 would have to be repaid. Now, and it goes back to also the round 1 loans that are being forgiven, the EIDL advance is not being deducted from the forgiveness. We're waiting for guidance on how they're going to pay back the borrowers who did not get the full forgiveness and started making payments towards the EIDL. So far, no information forthcoming yet regarding that. And next is the uses of the loan. So this is for the 40%. Just to give everyone a bit of a definition on those covered operations. So software, cloud computing, human resources, accounting needs. So if you have software to help you track your costs, the cost for that software is an eligible expense. The covered property damage, also due to public disturbances, not just your natural disasters is what most people think of property damages. And again, if it's not covered by insurance, that cost is an eligible expense. And the covered suppliers, again, your everyday for your goods that you need in order to run your business, again, essential, perishable goods. So again, definitions and details provided in the guidance. And the covered worker protection expenditures, with, as I said previously, whatever HVAC, again, under safety guidelines from the OSHA, from the state, from the local, that a business needs to do to comply with those particular guidelines. And again, it's like the sanitizer, the masks, a lot of the plexiglass dividers and HVAC costs. And I've seen a couple of questions of those. And again, it's in the guidance, exactly what HVAC purification, air circulation costs are eligible. And they now took the second loan. So how much can you borrow? The calculation is still the same on the second draw as it was for the first, in that, again, owners are capped at 2.5 months of whatever they had for 2019. You're more than $100,000 employees reduced down. Add all the eligible payroll costs, and it's 2.5 times. Mathematical calculation, you can't have a more than $2 million loan for your second. And again, the accommodations and food services industry, the calculation is the same. It's just the multiplier instead of 2.5 at 3.5. Seasonal employers, there is also a calculation for them for monthly costs, any 12-week period between the February 15th through February 15th of 19 through February 15th of 2020. And the other thing is businesses that are applying for their draws need to have been in business February 15, 2020 and must not be permanently closed. So if someone is thinking about, oh, I've closed and shut my doors, maybe now, with this PPP loan too, maybe I'll have a shot. It's only for temporary closures. And again, that's defined in the guidance. Temporary closures, temporary suspensions, but if you're permanently closed, you would not be eligible for the PPP loan. There is a certain expansions for bankrupt entities and individuals involved in bankruptcy. That was a new provision that I have to say that the loan application itself still says for the second draws and the first, if you're involved in a bankruptcy, your loan would not be approved. So there's a disconnect there between the CAA and the actual applications. Okay, next. So the NAICS code 72, and that goes back to a particular line on the tax return. So 1120, 1120S, partnership returns, and then Schedule C will have the NAICS code. It's in the IRS instructions. And bankers will be looking at applications and copies of tax returns to support that you have an NAICS code 70 that begins with a 72, it's usually 5-digit, or other documentation that proves that you're in the accommodation and food services. Let's say you didn't have that NAICS code on your tax return. They're going to look for certain licenses, et cetera, to support that NCIS code 72 accommodation food services so that you can have the 3.5 times the average monthly payroll costs. Now, you have multiple locations. It's capped at 300 employees per physical location. The affiliation rules that applied in the first round, there's been waivers for the second. You can only have one second round draw. So you have your first round and you have your second round, as well as the caps are not cumulative. So we have a $2 million cap, just wanted to end. You have $2 million loan cap on the second round, but it's not cumulative with your first, it stands by itself. They've waived fees to encourage the borrowers and lenders to participate. And again, as I mentioned previously, if it's loan round twos less than 150, the certification for the gross receipts deduction is usually when you ask for forgiveness, but again, follow what your bank is requiring for applications. Okay, and this next is,
Don't judge me on my answers.
All right.
Okay,
Um,
next is Matt.
Yeah, so now we're going to get into really the process for these second draws, and we'll go through the forgiveness application a little more. So for the second draws, there's a new form. They're very creative. They use the form 2483 SD, which stands for second draw. Once that's submitted through your lender, the lender will submit a request through the SBA website. The new form, the 2483 SD, has several new certifications. There's several additional certifications on this form. Some of the more important new certifications are that, like Elizabeth just said, that you have not received another second draw, that you realize a reduction in gross receipts in excess of 25%, 2020 compared to 2019. You can pick and choose a quarter or do that annually. That you've used or will use your first draw for eligible expenses. So that's one of the important certifications that, before you apply for your second draw, you need to either have spent all of your first draw funds or plan to use them all before you receive your second draw. And you need to certify that you're not an ineligible entity. The application, I'm not sure why, but they do pick the Republic of China and Hong Kong. So if your business was organized and follows the laws of China or Hong Kong, you are not eligible for a second draw PPP loan. There's a few other certifications in there that are new, but I think that these cover the most important updated certifications. As of now, the due date to apply for your second draw PPP loan is March 31st, 2021. Just like the first go around, if the funds were to run out prior to that date, until we hear further guidance that once the funds run out, that they run out. But as of now, March 31st, 2021 is the due date. I think I mentioned this on the previous slide, but if you do not take if you have not taken a first draw yet, you must do that before you apply for a second draw PPP loan. And the next few slides will go through the lender submission process a bit because it has changed from the first round of PPP. So once the application, the form 2043 SD is submitted to the lenders and they submit it to SBA, one of the changes for PPP2 is that there's a validation process that takes place on the front end. In order to get approved, this validation process must be approved before you can move forward, and your validation message must be cleared. Once that validation process is completed, you will be granted a PPP loan number, or the lender will be granted this number, which will be shared with you. Some things that might hold this up is if you have a hold code from your first PPP loan, your second draw will not be approved until this draw hold code is resolved. And once we get on to the next slide or two, we can go over some examples of these hold codes. But there could be a variety of reasons why this hold code is holding you up. In 2020, they weren't running these loans through a validation check up front. They were doing as far as I understand, they were doing these checks on the back end after the fact. But now this validation check is being done up front. And so some examples of these hold codes, this is not all inclusive, but some of the more popular reasons why your loan may be held up. If your TIN does not match, that you entered on the form does not match your supporting documentation, or if you do not provide proof of this TIN. If the entity name does not match, so your application entity name needs to match identically to your supporting documentation. There is a section on the application for your DBA. If you have another name you're doing business as, make sure you put that there just in case. It can only help you during this validation process. And then, proof of operational status. So one of the certifications is that you were in operation as of February 15th, 2020. So having that proof and will preclude you from being held up in the validation process. So one of the great additions to the CAA was that if you returned a portion of your first PPP loan, Due to all these new regulations, I'm sure some of you may be interested in getting that money back, or even increasing your loan amount because of these new rules and regulations. So they do allow you to do this, and it requires the administrator to release this guidance within 17 days of enactment. So if you returned half your loan because you were concerned about the tax implications or the forgiveness eligibility, and you realize now that you are eligible for this money, you can re-request these amounts. Next slide. I know Elizabeth touched upon this a little bit. To determine whether or not your loan will be forgiven, the forgiveness process really has not changed. Your payroll costs still must be 60% of your loan amount. The other 40%, Elizabeth went over the covered expenditures that can be included. You still need to determine that you did not have an FTE reduction or salary reduction rules. They all still apply. So your wage reductions, anything per employee in excess of 25%, will cause your forgiveness eligible expenses to be reduced as well. The next slide. So, a question that we get a lot is, really surrounds this wage reduction and this FTE reduction. So, just to clarify, if you do have an FTE or a salary reduction, and that needs to be applied to your loan forgiveness, it's applied to your total eligible loan forgiveness expenses. So if you have a $100,000 PPP loan and you have $150,000 in payroll that you want to include for forgiveness, and you have some sort of salary reduction or wage reduction, that's applied to the 150,000, not your 100. So after the reduction, if you're still above the total loan amount, you still have 100% forgiveness. So just because you have one of these reductions does not mean you do not get 100% forgiveness. And I just thought that was important to mention because that's one of the most popular questions that we get. And then also reductions in employment or wages that occurred during the period beginning on February 15th, 2020 and ending 30 days after enactment of the CARES Act shall not reduce the amount of loan forgiveness if by June 30th, 2020, the borrower eliminates the reduction in employees or wages. And okay, next slide.
I was going to say, I think that this is actually updated since then. It's by the end of the year. So that was by December 31st. And now I think I read, I haven't had a chance to dive all the way in, but it's going to be by the end of some period in 2021 because of the new draw 2.
You go to the next slide.
Yep.
So our experience with, we've helped clients with several forgiveness applications, and some things that we're noticing are that, several banks have, shut down their forgiveness portals entirely so they can update their portals to reflect these new changes from the CAA. Others have suspended or shut down the portal for all applications under 150,000 so they can accommodate for this. And then others we know of a few that have already back up and running. So depending on what bank and financial institution you use for your forgiveness, it could impact when you can actually submit your application. We've advised our clients, if you do have a loan of 150,000 or less, to hold off until the new form, the 3058S, is up and running. It's a much simpler form. There's less documentation that you have to submit. So we've been advising clients to hold off on that. I know that a lot of the portals, I'm just thinking of the few banks that I've worked with, they're all saying that by mid-February, which is coming up soon, they expect their portals to be up and running. So I would look for your banks to be ready to receive all forgiveness applications by the middle of the month.
All right, so how can we help? So Mercadien can assist you with your loan application preparation, or we can help assist you with reviewing your loan application. We can also assist you with cash flow projections to determine any funding gaps, how to apply expenditures to the various revenue streams Sherry had talked about earlier. And we can help either review, consult, or develop some of your cost allocation plans as it relates to charging costs back to different programs or different funding streams, with certain exceptions. We can also review cash flow projections that are prepared by management. There's additional funding that was, or some of the additional funding that was provided now makes certain recipients require additional audit under uniform guidance. So we can help with the audit preparation for these certain grant expenditures. We can all, as Matt indicated, we've been assisting with loan forgiveness applications, the preparation thereof, as well as reviewing any forgiveness applications that are prepared by borrowers. And general advisory services in connection with disaster planning and management, and assistance with identifying any other type of assistance or grant programs that are available. There continue to be further developments in this area, specifically in the hospitality industry, and as well as the theater and arts and entertainment sector. Next slide. So now we're on to our questions and answers portion of the webinar. I've been fielding most of the questions in the chat and providing answers to some of the specific questions, but there was a couple of questions that were submitted ahead of time that I just wanted to review and provide some input on. So I'm gonna address the question and kick it over to one of our panelists.
Kyle, I think I'm going to just stop sharing. I'm going to stop sharing, and then I think we can probably, everybody can see everybody if they so choose. Does that make sense? Hello?
Yeah, that's fine.
Okay.
Just don't forget we have the contact information up there as well.
Oh well.
Um,
It'll be
so-
out there, right? We're going to post the slide deck, correct?
right. So
Okay.
that was one of the questions, was about will the slides be provided after today's webinar, and we will provide a copy of the slide decks along with a recording of today's webinar and the evaluation for today's webinar. So most of the questions I've gotten, and I'm not surprised, have been about the Paycheck Protection Program, and I've gotten some questions about the Employee Retention Tax Credit. So as it relates to the Payroll Protection Program, withdrawal number 2, for borrowers to calculate the 25% revenue reduction, one of the questions that was submitted was, is it required to be quarter compared to previous or any given quarter in 2020 compared to the same quarter in 2019? Or can you do a consecutive 3-month period within that time frame? So Elizabeth, do you want to answer this?
Yes, so it is 1 quarter to 1 quarter comparison. So for most borrowers, they were hard hit the second quarter of 2020. That's when their gross receipts were probably the lowest based on what we've seen in discussions with bankers and such. So let's say your gross receipts were for that second quarter of 2020, 25% lower than the second quarter of 2019. Now, let's say, for instance, you were an essential business, you were open, and I've had this, your gross receipts were actually higher. Well, take a look at the third quarter. Does the third quarter 2020 compared to third quarter 2019, does that hit the mark? And then you would also look at the fourth quarter of 2020 versus the fourth quarter of 2019. You only need 1 quarter, either the second or the third or the fourth, that hits that less than 25, that the reduction is more than 25% compared to the 2019, or an annual can be used. Annual sometimes might be more relevant for a Schedule C that have quarterly, because I know sales tax is sometimes used as support for gross receipts to the business. Again, depending on what the bank's going to want. Maybe they don't have internal financial statements that often. So you can do an annual. Did your 2020 drop to more than 25% compared to 2019? So, and you don't have to add up all of the quarters. It's just a quarter to quarter comparison. If your loan is more than 150, you have to state on the application which quarter and supply the support, whatever it is that your bank is requesting, that shows that gross receipt reduction.
Great, thank you. And then similarly, another question is about the method in which you would use to compute the gross receipts. So some taxpayers might follow a cash basis method of accounting, and others who have applicable financial statements may follow an accrual basis of accounting. So Sherry, when interested borrowers are looking at their gross receipts test and seeing if they qualify for the 25% reduction, what methods can borrowers use to compute their the reduction?
I think that what they need to do is use whatever method they normally use for their tax reporting. So as I think I mentioned during the webinar, this is so much of a tax driven and tied to the Internal Revenue Code computation and support. So if you file your tax return on the cash basis, so for example, if you have a Schedule C and you use the cash basis for your Schedule C, then you're going to use your cash basis to determine whether or not you have a reduction quarter over quarter or year over year. If you're an exempt organization and you file a 990 and you use the accrual basis for your 990, and you likely are getting an audit and you have use the accrual basis for that as well, then you're going to compare calendar quarter over quarter or year over year using the accrual basis.
Great, thank you. Another question that just came in through the poll, are LLCs eligible? And if the LLC pays a sole employee through shareholder equity instead of straight paycheck, would the LLC still be eligible if requirements are met, i.e. more than 25% reduction in revenue? So I think what you're describing here is a single member LLC that would report on a Schedule C. So there's specific instructions about how to compute your revenue. And I believe you would look at line 31 of your Schedule C. You can do that for 2019 and compare it to a projected net income on your Schedule C for 2020 to determine if there is a 25% reduction in your net income for your business.
Yeah, and just to clarify, it's gross receipts that the comparison is on, if I understood the question that you read.
Right, okay, yeah, the 25% reduction in revenue, right.
Right,
Not,
yeah,
not the
and
PPP loan itself.
yeah, and Schedule Cs also have to, and so does partnerships, because Schedule C for eligibility to even apply, that line 31 that you mentioned, if it's a loss, then you're not eligible to apply for a loan for the what I'm going to call the owner, the owner portion of. So if that's it, you don't have any employees, then you're not eligible. Your partnership self-employment line, if that's a negative. So there's some fine, again, as Sherry has said, and I had said previously, you really need to go back to certain lines in the tax returns for calculations for the gross receipts and for certain eligibility requirements.
And if I could just add, so when you are self-employed, and I think this goes back to the direct question. So an LLC, you can either be taxed as a self-employed person, so Schedule C, or you could be taxed as a corporation, or you could be taxed as an S corporation. Whatever the tax rules are that apply, if you're in a self-employed environment, you are looking at owner replacement income if you don't have employees. So That's why, to Elizabeth's point, if you have a loss on your Schedule C or a loss on your K-1 from your partnership, there's no income to replace because your income is not tied to a salary. It's tied to withdrawal against your profit.
And one of the things I'd like to clarify, just because it occurred to me now, is one of the questions. Subcontractors are not your employees. The subcontractor, independent contractor, will apply for his or her own PPP application. I think that's part of the payroll costs. Some people think of the subcontractors as employees, but they are not. You are looking for employees, you pay wages, 941 forms are being filed, et cetera, W-2s.
Okay, we just had another question come in through the chat. For the 25%, what receipts are eliminated? So what receipts are not, or what receipts are not included in the computation? I guess the only thing that I'm aware of that is specifically excluded would be the proceeds from the PPP loan. If they are forgiven, they're excluded from the gross receipts test. Is there anything else that is not included in gross receipts when computing the 25% reduction?
The EIDL advances.
The EIDL advances, okay.
Yes, that's, again, you're going to have, because it's so tax intensive tax returns, you're looking at your gross receipts from the sale of services, the sale of products, interest income. Again, the nonprofits, as was shown earlier, capital gains or sale of assets and such. So you really have to go with what type of return you're filing and lines on the return that the guidance is saying you need to look at.
So I would think all these different tax credits that we were talking about. So if you have the employee retention tax credit, in essence, that is a reduction to your employer share of FICA. So, you know, you may be reporting that as a direct reduction to your FICA expense in your general ledger, or however you're keeping your books, or you might be reporting it as revenue. I think that if you're reporting that as revenue, I think that there's an area of gray or shade of gray there, depending on how you've chosen to do it.
Correct. And that's where, again, the guidance of CAA points back to however the Internal Revenue Service defines or in their instructions, the particular lines on the returns. So if they say this has to be included in gross receipts, then that's where you have to put it.
Mm-hmm.
Again, it's like I know a C corporation, there's like the line 11 and there's like the total receipts. They say, well, since that's reduced by cost of goods sold, if you have that, you need to add back the cost of goods sold to come back to your gross receipts. But some of it is very easy to calculate, some of it is not. And again, the underlying is you have to make sure your tax return is properly prepared.
We have another question that came in through the chat regarding the FTE credits. So I imagine this is the employee retention credit. Would the formula be gross payroll less the first PPP loan, assuming the entire loan was used for payroll? So Caitlin, I think the question that's being asked is when you're looking at the payroll that was funded with proceeds from the PPP loan, when you're calculating the eligible wages, how would one go about doing that for the employee retention credit?
I think we need to back out and see which payroll was forgiven, so that only the payroll that is was not incorporated into the PPP is being used as qualified wages.
So if you start with the population of all eligible wages, when you're looking at what credits you may be entitled to under the employee retention credit, any payroll that was funded or paid for with proceeds from a PPP loan that was requested to be forgiven or had been forgiven we would have to back out that specific payroll that was funded with the forgivable portion of a PPP loan.
Correct.
And
There's no,
And I just wanted to mention that there was a request that was submitted into Internal Revenue Service from the AICPA on further clarification around this specific issue. Because whether a borrower either requested for forgiveness or had gotten the loan forgiven, there's still some unanswered questions in that area. So further guidance will be forthcoming in that area, as well as Caitlin had mentioned earlier, about amending 941s. The IRS's website currently has not been updated to reflect some of the new changes from the Consolidated Appropriations Act. And then a question came in just about how the loan would be treated on a tax return. So Elizabeth, I'm guessing this relates to the PPP loan. When if a loan is forgiven, or what's the criteria for reporting the Paycheck Protection Program loan on a 2020 tax return for a tax-paying entity?
Okay, well, I haven't seen the instructions yet for the forms. Some forms are still in draft. But just to take it from how it's generally done on a return, if you have tax exempt income, and this is what the PPP loan proceeds are, once it's, forgiven, because it's currently, until it's forgiven, it's a loan on your books, on the balance sheet. So let's say it's forgiven, so it's tax exempt income. There is usually a certain section on 1120s, 1120S partnership return that says, here's your book. What is on your books that's not going to be on your tax return? And so that would be the proceeds from the PPP loan that says that if you've already included it, obviously it's in your books, part of your revenue section of your P&L. That's how a lot of people are putting it, even though after it's forgiven. And so you would take that dollar amount out and say, this is tax exempt income. This is not part of the taxable income. Again, this is M1s and M3 sections of the returns. And that's how it would be shown whenever you have tax exempt income. So I don't know if there are a specific lines going to be put in there, or if it's just going to be part of the income reported on the books, but not on the tax return.
But I definitely wouldn't add it into, if I'm like, for example, on a Schedule C, I
Right.
don't even know that there's a place on a Schedule C for exempt income. So you just
Right.
don't add it in. And if the IRS audits you, you have your QuickBooks file that has the revenue in there, but you didn't include it in your tax return. And that's because by Internal Revenue Code, it's excludable.
So Sherry, as I thought about the changes that came out of the Consolidated Appropriations Act, for nonprofits, what are some of the things that nonprofits should be doing right now to determine their eligibility under either the Paycheck Protection Program or the Employee Retention Credit?
Well, at this point, I think, so a lot of our nonprofits knew, especially the ones that shut down. So there were some health and welfare organizations that were literally precluded from opening for a while back in 2020. And they had to decide if they were going to take the PPP loan or if they were going to pursue the employee retention credit. At this point, since you can now go back and actually get that credit, I would definitely go back and take a look at what my opportunities are to reduce my FICA expense in 2020 by availing myself of that credit. And then, if I have to, I'll file amended returns. And right now, based on whatever your facts and circumstances are, it's not the federal relief plans are not just the only relief plans. So I would be looking at my ability to get a new PPP loan, second draw. If I didn't take my first draw because I took the employer retention credit, maybe you need to be looking at a first draw and then a second draw currently, and then looking at how it interplays with the employee retention credit, and then looking at whatever the other potential funding sources are, depending on the type of business that you have. I mean, there's state EDA opportunities out there. There's FEMA opportunities out there. If you're in the healthcare space, there's provider relief funds. There's just really gaining an understanding of what all of the relief opportunities are and kind of flow charting whether or not they're available to you, and then what gives you the biggest bang for your bucks in terms of business bottom line.
Right.
It's a lot of work and it's very confusing. You know, I sit here and I think about, I'm like, okay, so PPP is 25% reduction on round 2, but the employee retention credit is 20% compared to 50%. It's a lot to digest. So if you feel overwhelmed in our audience, trust me, we are too. A lot. That's why there's 5 of us here today, because we're each trying to make sure that we dig deep enough to really get our arms around it at a level where we are confident about our knowledge. And then if there's a question that's not answered, we know where to go to get the answers, and we know what's still pending.
Right. And as it relates to draw number 2 available under the Paycheck Protection Program and the Employee Retention Credit, I guess if I were in the audience, I would be computing my gross receipts under each of the programs or incentives that are out there to first determine if I qualify, and then go from there. So the first hurdle is determining whether or not you qualify. And I think, Elizabeth, as you covered before in the Paycheck Protection Program, there was a change under draw number 1. You were capped at 500 employees. So an eligible borrower have more than 500 employees. And now that number has been reduced down to 300.
Yes, that's correct. And I know from experience with a client that got draw 1 is not eligible for draw 2 because of the employee cut. That organization was close to the 500 and they're way over the 300. So businesses do have to reassess their condition, because you may feel you have an economic need, your business is hurting, maybe you've had to lay off people, you feel the traffic to your storefront or your website has gone down, but you need to look at the numbers. I've already seen some clients where they've given the numbers, and yes, the quarter went down, but not by the 25%. It went down 17, more than 17, but not the 25. So you did have a reduction, but it's not as much as you would need for the PPP loan 2, or it may not be what you need to hit for the employer retention credit. So it is very important to start looking at the gross receipts.
And then another question came into the chat about the deadline to apply for or modify, essentially extend your 941 for the employee retention tax credit. So as far as I'm aware, and I just went out to the IRS's website, there is not information about the deadline. I believe there would be a statute of limitations to amend those returns, but the IRS has not provided any guidance or further clarification about amending any 941s for what I call the expansion of the employee retention credit as a result of the Consolidated Appropriations Act. So there is going to be definitive time that you're able to amend those returns, but the guidance should be forthcoming from the IRS.
I would say, though, as of now, it's whatever the statute of limitations is. So federal is usually a 3-year statute of limitations. I'm not sure about, is there a different statute on payroll returns, Elizabeth?
I don't think so.
I don't think so either. So
Yeah,
I would say that it's going to be, you have 3 years from the date that you filed your 941, absent anything else that comes out. If they're going to increase the statute, it will, I don't think it's been done in the CAA, not
Yeah.
that I'm aware of. So that means that it's either going to have to be done in a separate regulation or in another subsequent act. So as of now, I would say you have 3 years from the date you filed your 941.
Yeah, that we'd have to go by default.
Mhm.
One of the things I just want to bring up I'm going to throw a monkey wrench into everything, obviously. But when we talked about the expenses used towards the PPP loan are deductions. They're deductions on your federal return. The CAA addresses a lot of federal guidance.
Point.
The state, I actually was on a CPE myself last week. State of California apparently says, no, you will not be able to use those costs as deductions. New York apparently will allow you. New Jersey, I don't think has made up its mind yet, which is hard because the tax returns are, need to be filed. And so if you're a multi-state business, you need to really look at each state that you have to file in, because you may have a state that you're allowed to take those deductions and a state that you're not. So record keeping, bottom line is careful record keeping is very, very important, and making sure you have your forgiveness application and all the underlying information to properly do the tax returns.
That was a really great point, Elizabeth. The state, what about, that was the expense side of it, but what about the revenue side?
Right.
Are the states, I think, did New Jersey couple up with federal on the forgiveness being excluded? I feel like they did. I feel like they coupled up on the revenue side.
They
but we
may
don't
have
know.
coupled, yeah.
So it's not just the expenses.
Right.
The feds say that it's not income for tax purposes, for federal purposes, but your state may have a different guidance. So that's a
Right.
great point, Elizabeth.
So we're running close to the end of the time. I just wanted to ask one more question of Matt. Matt, if anybody in the audience has received their first draw of the Paycheck Protection Program loan and has not yet applied for forgiveness, what are some of the recommendations you have for them as it relates to gathering up the appropriate sufficient documentation that may be required? What are could you just touch base on some of the required information that they should be compiling and reviewing?
Sure. So every bank is asks for slightly different list of documentation, but the easiest would be if you work with a payroll provider. A lot of the larger payroll providers have CARES reports that run all the forgiveness expenses for you, including payroll, your state and local taxes, and there's FTE calculation reports that these payroll providers can produce for you. It'll also these reports will also produce calculations for your salary reductions for your covered period. In addition to that, a lot of banks will require you to upload tax forms, so your 941s, your in New Jersey, your NJ 927, your UC filings for any quarters that your covered period covers. So you want to get them compiled. If you do not have one of these payroll providers, payroll registers, making sure that you're not double dipping. So at Mercadien, we have a little template where we throw in all of the relief that you've received over, during 2020 to make sure that, the payroll that you're seeking forgiveness for was not reimbursed by any other form of reimbursement or COVID relief. Some banks require you to produce bank statements. Trying to think if I'm missing anything else.
The revenue reduction, you have to be able to prove that now. So you've got to have that ready.
Yeah, so for the second draw, yes. So you need to prove your 25% revenue reduction when you're applying for your PPP loan. And as Elizabeth stated, that could be tax returns, I know a couple of banks that I've worked with already, they accept bank statements or interim financial statements. If you have investment income, your quarterly investment statements are adequate support to support your reduction and things like that.
And I guess if you have not prepared your forgiveness application and you think you may qualify for the employee retention credit, it's probably incumbent upon you to try to claim as much non-payroll expenses in your forgiveness application. Since when you're looking at the employee retention credit, you have to back out those wages that were funded with loan proceeds from draw number 1 of the Paycheck Protection Program. So there's a lot of interplay, and as Sherry said, you kind of got to take inventory of everything and strategically think through what you have to do in terms of moving to the next step. And it's very confusing, and the rules and regulations for each of the programs are different. So you're in good company if you're still confused. So with that, I think we're out of time. I wanted to thank our panelists and presenters today, and I wanted to thank everyone that was able to join us today. So we hope to see you all over the next few months, and as we look forward to getting back to some form of normalcy. So thank you, everyone.
And we're going to put out the slide deck, correct, with our
Yep.
information. Okay, good.
Great. Thank you, everyone. Bye-bye.
Bye.